Boom, we are live. SoFi Weekly special episode with the guest, the Stock Market Nerd. His link is in the description. Riley's putting his Twitter in the chat. Thank you for joining us, Brad. Happy to have you.
Happy to be here. Happy Friday night, everybody.
Yeah. Do you guys want to just jump right into it? We all saw Q4 numbers. What did you think?
Just zero small talk. All right.
Wait, sorry. I'm not good at this.
Tanner, let's like
who is this guy?
a little bit, bro.
Who is this guy? I want to talk numbers.
Tanner's been waiting all week for this.
I know. Go ahead, Brad. Who are you?
Yeah, so Brad, can you give us a little rundown of who you are? You are obviously a big stock market junkie. You have an awesome personal brand. So tell us who you are on the internet.
Yeah, I am a nerd when it comes to stocks. So on Twitter, like I'm called, or the handle is the Stockmarketnerd. So I am Brad. I'm 25. I'm from Michigan. I worked for a fund for a very short period of time. Got my master's in finance. Worked for Motley Fool for a few years, and then started writing my own newsletter. And I tweet and write for a living, and love every second of it. And as evidence of that, on a Friday night at 9:45 p.m., I'm talking with my friends and colleagues about stocks instead of doing what I'm sure most of my friends are doing right now, which is not talking about stocks. So, let's talk about SoFi. And
What, if you don't mind me asking, when did you hear about SoFi, and what was the first thing that like got you into the deep dive of like learning about SoFi?
Yeah. So candidly, it was during that SPAC craze. So a few of those presentations drew me in. I think I ended up investing in like 3 of them, and SoFi is the only one left that I own. But really, it was a very charismatic presentation, and the projections that they offered were extremely exciting, and this value proposition of combining the back end and the software with the front end consumer facing product, and saving on things like on software stacks via vertical integration, and being able to sell that to competitors, and taking part in this this explosive fintech growth, and instead of just relying on brand and brand power to kind of win in what's sort of commoditized banking space. But that kind of competition agnostic branch, which is what I view Galileo and Technisys as, was really what got me so interested in SoFi, and what made me want to dig in. And then also from the beginning, like Noto and that presentation, they were very arrogant. Not arrogant. That's a bad word. They were very confident. And they delivered. I can't believe I almost said the word arrogant, but I didn't.
That's okay. We've said worse about Noto on the pod,
so we're live. So I'll mess up a few times. It's okay. But the charismatic presentation paired with that kind of value proposition of not solely relying on a brand, and the power of a brand, which is a very abstract thing and a very abstract concept, is what made me like SoFi more than all these other kind of fintech risers and digital wallet competitors that I'm sure all of you are familiar with.
So Brad, just going off of that question, where does SoFi sit relative to other holdings for you? Like the weighting, and then maybe just a general sort of glimpse into your portfolio, like in terms of number of holdings or whatnot.
Yeah, absolutely. So I own 19 companies. I would say, so let's see, doing a little math on the spot here, so it's going to be a little inaccurate, but 90% of my equity is in 14 names, or 13 names, because one of those is cash. So 13, and then SoFi is number 9, but I mean, it shifts between 4th largest and 10th largest on a pretty much daily basis. Like they're very tightly packed in. I think the theme, or the overgeneralized theme of the portfolio would be growth and innovation and American tech, and SoFi, I think very clearly fits in that theme.
So you first found out about it during the SPAC race. Have you just been sort of DCAing your way through, or how do you approach that?
Yeah, so DCA. So I've been adding pretty aggressively over the last 6 months. So I did pause for a little while, as things, I guess, as multiple just as the discounted cash flow models that you write just couldn't really justify where stuff was getting. Candidly, I didn't sell very much, so I'm not patting myself on the back for avoiding what was a blast of a 2022. But really started accumulating and accelerating that accumulation pace a few months ago. Kind of around when Noto was, so almost using him as a signal, but not using that as the sole reason. But really, when the EBITDA multiple kind of got around 20 in terms of forward EBITDA, is when I started to really lean in. And yeah, I mean, I don't know what my cost basis is off the top of my head because it's in an article buried in the newsletter, and this cost base is not accurate on the thing I'm looking at. But I think I'm still a little bit in the red, but that's okay. Long-term invested.
Is your last public portfolio summary back in September of 2022?
Yeah, so I actually stopped doing those when I started working with this company called Savvy Trader. And essentially, so every news of the week article that I write now has that screenshot of my portfolio so that everybody can kind of track it. And then in news of the week, when anything changes about plans in terms of accumulation or pausing, adding, or selling, it's all there. So just kind of changed it from doing it every 3 months to wow, that was a very attractive voice crack, but doing it every 3 months to kind of doing it every weekend. And yeah.
Yeah. So what he's also talking about is his Substack. Is that also linked, Amit, down in the description?
That is not. I'll do that right now. Get that there.
Yeah, because that's seriously a wealth of knowledge for anyone that's looking to read into not only SoFi, but a myriad of other stocks that he's also covering, which I recently, over the past weekend, just read through his entire deep dive of PayPal, which I don't know if it was in terms of actual papers, how big it would be, but it was probably like a 30-page read, just stacked full of PayPal knowledge. And I don't know, have you done one on SoFi, or do you still do those deep dives? Or
yeah, they so the weekly articles really have I mean, as if anyone listening is a reader, they're pretty long and take up most of the week, but so the deep dives really come like once or twice a year, or like 2 or 3 a year actually. So the last one I published was actually on PayPal, but I've only done, I think, like 6 or 7 of them. And Shopify is actually the one that I'm about to publish next, which hopefully we'll be able to do that sometime in late February after the report. But getting close, it's always it's always so like it's always such a relief publishing them because they really do take a long time. Just uncovering every rock that I can possibly uncover, and yeah, so this one hopefully will be it's probably going to be 30 pages or longer, so I apologize in advance for that. But
and when you do these deep dives, do you like really enjoy the process of spending days or weeks to bring up these 30 pages?
Yeah, I enjoy it because it's like, in my mind, it's the homework required. It's the work required to like truly know what you own and truly understand the investment, so that you can truly, saying the word truly too many times, but you can actually understand like when a fundamental bull case is changed and weakened and can be, I mean, can kind of understand that weakening versus when you're sort of buying stocks and maybe not following along as closely. Not really understanding, and in that scenario, I mean, downward price action like we've seen for the last year becomes extremely intimidating and anxiety provoking and daunting, because I mean, you own a symbol and don't really understand the health of the company, and don't understand if that health of the company has truly changed and truly changed permanently for the worse, or if it's that old saying of baby being thrown out in the bathwater. So it's at those opportunities when, I mean, all of us that's when we can generate alpha, when we can identify those babies that have been thrown out in the bathwater during these, not to sound selfish or insensitive, but sort of exciting times when we get these massive doses of multiple contraction and valuation resets where hopefully if I'm right, and I can always be wrong, and hopefully we're all right, but hopefully SoFi is one of those babies that was thrown out in the bathwater, and from the low, so far so good. It's been, I mean, it probably got a little bit ahead of itself, but I'll try to stop blabbering right now, and we'll move on to the next question. But,
yeah, no, I just wanted to bring this up, just so then people understand, like, whenever we say deep dive, it's not like, you know, a half-hearted attempt. I mean, there's 11 sections to this page, and just to give it to you guys, I'm still in section 1. There's section 2. You know, this bar goes deep. Okay, so this is a deep dive into a company. I read this entire thing on the weekend, and I probably know PayPal more than most now, so I appreciate that, Brad.
I appreciate you reading. I mean, it is it's almost a novel. It's a yeah, they're very long, and I honestly need to get better at making it not that long because brevity is really not. It is a weakness of mine. So I'll try to get better at that. But hopefully it wasn't too redundant or anything like that. But yeah, thank you for reading. Appreciate it.
Yeah, no, absolutely, absolutely. And I think that's also what really, drives success is just a great product. And that's obviously why you've amassed all the followers that you have and more to go, is just because you're putting out a great product and it's free for anyone that wants to read. So please go check that out. But can I please have it now? Can we go on to some numbers now?
SoFi is up how much this week?
A lot.
A lot?
A lot.
A lot. So obviously we hit it out of the park with earnings in some sectors, in some places not. Stock reacted well, 18% the morning we were live streaming earnings, which is Monday, and then it rallied another 20% after that. So yeah, Tanner, let's get into it. Let's get into the numbers.
So I wonder if maybe we can bring up the snapshot or something from Brad here, and then that might be a good way to just see his first impression thoughts, and then maybe we can dive a little deeper into some other things, talk about some things that he's seen maybe in the earnings call. Obviously, we don't have the 10Q yet, so he hasn't been able to be too nerdy just yet and dive into the actual numbers, but just first impressions for now. And I also, actually, I got to bookmark this. I just saw your operating leverage page right here as well. So anyone have that snapshot? I wasn't quite prepared, unfortunately.
I can pull it up. I'm not really sure how to give it or like put it on the screen, but I can.
I got it.
Oh, you got it? You got it?
Yep. Just going forward, just there's a present button at the bottom. Hopefully that will work. Let me see.
Yep, we got it.
Boom. Okay.
These are epic, by the way. This is what gave you. This is your bread and butter on Twitter. Like this is your thing.
It's not letting me zoom. However, I'm trying to zoom, but it's an image.
Twitter loves pictures. They really love pictures.
Yeah. Give me a second, and I'll see what I can do.
Okay. So
if you right click it, you can open image and new tab, and then be able to zoom.
That's what I'm doing.
So hey, stock market nerd, Brad, what was your what do you think what were the few critical factors of SoFi's Q4 that you think really just add to your bull thesis, and then maybe something off the top of your head that you're worried about?
Yeah, sure. So I mean, honestly, I don't mean to get down on the company, but it wasn't their best report for sure. Like they've had. It's funny because it's been the best reaction in terms of share price, but it was probably their worst report in like 3 or 4 quarters, I think. But I mean, they still, and I say worse, and it was still a very strong quarter. I mean, they beat on the top line by 4%, despite not getting that December student loan volume ramp that they were anticipating. That was in the guide. That was in the guide that they set out in the previous quarter. So I mean, beating regardless of that and continuing to compound at a 2-year clip of well above 50%. Now we're at like pushing a $2 billion revenue run rate for next year. It's getting pretty big, and the growth is still strong, but growth doesn't matter unless there's operating leverage and kind of like was hinted at. There's been plenty of that. So not only did they expand their EBITDA margin by 1,400 basis points year over year from 1.6% to 6%, and I think for the full year it was like 2.7% last year, and then 9% for 2022 or something like that. Don't quote me, and that could for sure be wrong, but pairing that, and I know some people hear adjusted EBITDA and roll their eyes, and that's fair. But pairing that with the guidance we got from management, where I mean, for a while it was sounding like, yeah, we'll turn GAAP net income profitable at some time in 2024, and then they moved it out to Q4 2023, this past quarter. So I mean, backing that up with saying they're, and then I had to do a double take when I had to go to the transcript the next day to reread this to make sure that I read it correctly. But the incremental GAAP net income metrics that they gave out of 42% in Q4. I don't know the full year one that they gave out, but it was pretty gaudy. It gets you excited about like where this company can be in a few years, especially when their big money loser, which was financial services, is now they're reiterating contribution profit positive sometime this year. and they're at negative 67%, which is not great. I will give people that. That does not sound good, but it sounds a lot better when you hear that they were at a negative 160% margin just a year ago. So I mean, rapid operating leverage there. It's going to turn positive at some point this year, and then to combine that, so really across the board, exciting from a profitability standpoint with a tech platform where we've gotten some operating deleverage over the last few years because they've been spending so aggressively on Galileo, and now Technisys is a margin headwind as well. But them telling us in 2023 margins are going to trough, and we're going to start to have leverage in that segment as well. I mean, they're clicking wherever they can click, and unfortunately, this student loan thing is really, I mean, annoying, and I hate politics, so I'm not going to get into it at all. All I'll say it's annoying is that it is annoying for SoFi's financial results, for its potential, because it is really lowering the ceiling. But at the same time, I mean, they're going to have a decent share of the market like they had before the moratorium was in place, whenever it comes back. But yeah, so things that concern me a little bit. So two things that I would point out. One is along the lines of that moratorium, which is they are now anticipating that, or their guidance anticipates that they get that student loan volume ramp starting 60 days after June 30th. So late in the summer. And I mean, Anthony Noto and the team know a hell of a lot better than I do when that's going to come back, but really none of us know when it's going to come back, because politicians suck and they work really slowly and they all have their agendas, and we really don't know. So relying on that timeline, like we relied on it in the past, makes me a bit uncomfortable, and maybe just take it out of the full year guidance and create a little upside surprise would have been nice. But that's kind of picking at straws. And then the other thing was some language around Galileo and the tech platform. It sounded like to me, and maybe you guys disagree, and please tell me if you do, but a client leaving to their own payment processor and costing them $6 million in revenue. So to me, that sounded like churn. And the second thing was that changing go-to-market from maybe weaker fintech players that they're not confident can actually survive this downturn, which is fair. I mean, focusing on stronger players that have the balance sheets to actually survive this looming recession or whatever we find ourselves in is fair. But then saying that our growth organically is going to slow to low double digits and then accelerate thereafter, but kind of a little bit concerning there. And then Technisys will add to that organic growth too in the first half of the year. But that was a bit underwhelming to me, and I would like to see that reacceleration like they're telling me to expect in the second half of the year. So something I will be watching quite closely. But all in all, it was a really strong quarter. I mean, for the year, their loan market share went from 4.5% to 6% of their demographic, which is extremely affluent, which is why their charge-off and delinquency rates still look so good, which is not the same for all of my holdings right now. RIP Upstart, but yeah, that was the 30,000 foot view in my point from my point of view, and would love any thoughts from you guys, because I mean, you guys know the company better than I do. You guys follow this all day, every day. So let's hear from the experts too. I mean, I followed. Yeah, go ahead. I'll stop.
So
you guys, I don't want to.
So first off, I'll say, you know, we have the SoFi Weekly. We talk about it. It makes up about 10% of my portfolio. So it's not like I'm, you know, dumping headstrong
Tanner,
into
stop
this
trying
company.
I love SoFi. I love
SoFi, but I'm not sharing videos of Noto playing football. So,
oh, come on.
Sorry,
come
that's
on.
a joke over to Riley.
We started early today.
No, but I just wanted to make a comment very early on. You said it wasn't the greatest quarter from SoFi, and I agree. What I think was really spectacular, what the market liked, was that it really sort of proved itself to be the last lender standing in terms of Lending Club and Upstart and all of these companies who have been, you know, not performing very good in Q3 and Q4 when SoFi continued to put up great numbers. And even though it wasn't the best numbers we could have put out, we obviously are depegging ourselves from just an industry standard. And sort of that's what I'm really liking. But and also I wanted to touch on, I'm pretty sure it's a conspiracy, but from what I can see, that the customer that did leave was Revolut, which I'm pretty sure was a pretty large customer for us. In the same quarter, they said that they are partnering with Stripe or something along these lines to do a lot of their payments. So that right now I think is the I don't know. Word on the street.
Did not know that. Thank you.
I think so. There's two things to pick out, and since we're starting with the negatives, I kind of want to add one more to the list around the earnings. So student loans, pretty much in my mind, that's a write-off for the year, because even though they're going to start in September, they did mention on the call that it's going to be a very slow ramp after that fact. And I mean, look, I mean, it's been pushed 11 times or 12 times. It can definitely get pushed again, especially now that it's in the hands of courts. Like, that can be a long, drawn-out process. So it might not even be in their hands to ramp up. But so that's essentially a write-off for the year in my mind. Of course, the other write-off for the year is home loans. They did mention that they're transitioning to other fulfillment partners. On an interview with Fox, Anthony Noto also mentioned that they're not putting as many resources to home loans, just with the interest rate situation being where it is. So they're transitioning those resources to focus more on the personal loan side and more on the SoFi Bank and the checking and savings, direct deposits, that side of the business, because that's the side of the business that's clicking in this type of market, and less so the home or the student loan. So both of those two, I would imagine, are complete write-offs for the year. But at the same time, both of those have been piggybacked by personal loans for like the last 12 months, and they're on a like sequential and year-over-year decline. So I don't think investors are really counting on those to make an impact in the first place.
Right.
Yeah, and I think that's. Or sorry, I don't want to interrupt anybody.
No, go ahead.
No, I mean, I think that and that slowing is what's leading to what was their implied growth in the 2023 revenue guides, like 30-something%. So slowing from that 50% 2-year CAGR. So yeah, it's a good point. I mean, their growth is going to slow, but you like, obviously, ideally for it to be that slowing process, the first derivative to be as low as possible, and that is some significant slowing, which hopefully, like you're saying, and this home fulfillment problem has been an annoying issue for a few quarters now. And one of the analysts kind of pointedly asked them, he's like, well, you've been talking about this for several quarters and it doesn't seem like we've gotten anywhere. So what's going on? But I mean, that he's saying, and I'm quoting him, that they'll step on the gas pedal to take advantage of pent up demand. Noto is him. When this service quality issue is resolved, and kind of think to yourselves, okay, when is this going to happen? Because they've been talking about it for a year and a half now. And I think they've hinted sort of at wanting to actually own this part of, or own their fulfillment partners, because because they're not just performing up to their standards. And sorry, I go ahead. Yeah.
Yeah, so they reiterated that same point on the call and also in subsequent interviews, basically saying that their old partner got acquired, therefore it wasn't worth to sort of backtrack and link up with them. And so they've been spending the past like 18 or so months, making this transition. Noto said on the call that they had made more progress in the last 2 months than they made in the previous 18, just fast tracking a new partner. And the goal is, and so this is also something that I was thinking, now that they know sort of how much issues they have, or the external dependencies that they have on these fulfillment providers, they're so much more leaning into the fact that they want to go all in-house with home loans and every other part of their business as well. So it just leads me to think that since they took so long to get a new fulfillment partner, and now that they fast-tracked a new candidate, that candidate, whoever that is, just makes it a prime acquisition target from SoFi's perspective, just so that they don't run into this in the future again, so that they can control what happens there.
Yeah, no,
What are we looking at here?
Well said.
Who brought this up?
I brought this up. So this is Steven's latest article, and this is a chart on loans and student loan originations, personal loan originations, home loan originations, and total loan originations. The interesting thing here about the student loan debate is that I was listening to that same thing you were listening to, Brad, where Noto basically had to deal with that analyst asking about it, and they kind of said they've spent the past year not factoring that into their guidance or into a lot of their analysis. And so as a result of that, it kind of seemed like he was brushing it off. He was like, look, like, we get it. It sucks. It's annoying, but we've gone through the past 5-6 quarters without worrying about it, even though we've said it's coming. And so at this point, you got to kind of assume that we never know what may happen. So it would be the theoretical cherry on top once it finally does come, if it is resolved by June. But then again, Biden wants to get elected again, so it just might get pushed until 2024.
So just as an agenda, because I want to touch on some things just in the short podcast that we do have, Brad, I'd love to know your opinion on not only the topics that we're already talking about, but the risk of becoming practically a 70% personal loan business. I'd love your opinion on stock-based compensation, if you think that's a problem. Potentially even talking about acquiring potentially a home lender, if that's going to be a problem with you. And then I had another one, I forget, but yeah. Anyway, go ahead with.
I'm going to answer the first one, and then I might forget what the second one was. So if you could remind me afterwards, that would be greatly appreciated. But that's why it's so important to me personally that SoFi is very strictly underwriting to this tight credit band of customers. So I think it was their FICO for personal is over 745, and for student it's over 760, and mean income is well over the American average. And what that's really meant through all of this, and I mean, 2021 and 2022 have just been a phenomenal test of funding supply, durability, and sustainability. And again, not all have fared as nearly as well as SoFi. And the ABS or asset-backed security markets remain open to them throughout all of this. Like they were closing several hundred million deals through the thick of financial condition tightening and through the peak of Volcker taper tantrum or whatever you want to call it. And they were selling these gigantic loan pools while they were maintaining delinquency and charge-off rates well after this stimulus and payment holiday sugar high kind of ended. So the combination of their underwriting and how well, not only with the banking charter, how they're able to kind of use deposits and this cheaper source of capital to really juice the APY that they're offering to consumers to act as that really attractive top of funnel. But not only do they have that available to them, but when fast money hedge funds and these capital markets turned off for a lot of the market, they did not turn off for SoFi, and it continued to be business as usual because delinquency and charge-off rates remained so far well below the pre-pandemic levels, and they still are. And then Crystal Point kind of pounded his chest a little bit on the call and was like, yeah, that's going to continue. You can pretty much expect that to continue. That outperformance versus their competition. So it's been a hectic year. It's been a year plus, and kind of a rapid test of loan book durability. And SoFi's kind of passed that test with flying colors. So do I love that so much of this business is now loans? Not ideally, and I'd love Galileo and Technisys growth to reaccelerate like they're saying, because that's very important to me in terms of the bull case. But in terms of the quality of that loan book and how they've handled it through a really tough situation, it makes me a lot more comfortable with that concentration risk in terms of personal loans. And I think it'll ebb over time as we get that home loan product figured out, and as student loans turn back on. And as hopefully, again, we get that tech platform acceleration, and as Fin Services continues that explosive growth and eventually becomes profitable. So you can't just roll your eyes at the growth and discount it, because at some point it will be profitable growth. But yeah, I'm kind of sidetracking, and that's kind of how I see the personal loan concentration risk. And then what was the second question? Or sorry, go ahead.
Yeah. First, let me just show you guys this. Thanks, Riley, for sending this. But pretty much, as you can see, what it's showing is that student loan origination, home loan origination is decreasing, year over year. However, the personal loan origination has been so explosive that we've actually been growing our total portfolio year after year after year. Anyway, I just wanted to bring that up. Thanks, Riley, for showing that. But next, you just brought up another question. So let's just pivot on to another one really quick. What I wanted to talk about was Galileo and Technisys. I feel like they're pivoting sort of their own business right now. Obviously, slowing of VC funding of all these new fintechs or neobanks and everything like this. We're not getting nearly as fast of new clients in that section. However, now they've been talking like in great depth about the B2B market, right? Do you have opinions on that? Have you looked into potentially, Galileo and Technisys's total addressable market for that area? And then also, if maybe you can touch on, what the two companies and potentially SoFi as a bank does for the AWS of fintech as well, while we're just in that sort of tech side of the business.
Yeah, sure. So I'm going to try to answer all of that. There's a lot packed in there. So basically, so Galileo is very one dimension. It did payment processing. It had a phenomenal payment processing API and slick software, and it worked very well. But this whole theme of multi-core banking was something that it couldn't offer, which is what these gigantic B2B clients need to offer their customers. In terms of, so I guess it's B2B to C really, but in terms of what they're selling to these gigantic companies like H&R Block and some of these other bellwethers that they've landed, they require not only payment processing but checking and savings, and it sort of almost reminds me of Shopify by them kind of combining all of these business operations, and for them it's banking operations and banking functions into one platform and one back end, so that you have one familiar user interface, which is, there's a lot less friction for customers because it's familiar. It's an interesting value proposition. Sorry, my foot just cramped up a little bit, but it's an interesting value proposition for these gigantic companies that really struggle a lot with disparate user interfaces and with franchises all over the place that are using completely different tech stacks. So by being able to kind of, and this is going to sound a little cliche, but unify those disparate data silos and product silos, you can really create a much better experience, but you can also lower the total cost of ownership and maintaining that. But I mean, and then marrying that, you're sorry, what was the second part of your question?
Well, so so the B2B market space, and
I get excited. I'm
then
sorry.
the total addressable market. But I would also like to, do you think that it's only B2B to C? Because I also think that the B2B market, like for internal payments and payroll and everything like this, is also a pretty large market as well. But the total addressable market of AWS of fintech, what is it revolutionizing? You know, why would someone choose us over some of the bigger players?
Yeah. So I mean, it really is a matter of unification of all these products and operating on one technology core, but then also kind of plugging into SoFi Bank and saving a few hundred basis points on sponsorships and sponsor bank functions and things like that, by marrying this SoFi Bank with the technology core and all these things that they can do together. It really is about creating, it's two things: creating a better experience for the consumer in which they don't have to learn as much and don't have to familiarize themselves for so long with these products, but it's also, again, saving them on total cost of ownership. And I wish at SoFi, like all these companies, like Shopify and Olo, and trying to be the AWS of something else, of restaurants or of commerce or things like that, they publish total cost of ownership case studies and how much cost savings they're driving. And it sounds kind of gimmicky to say total cost of ownership is lower, because how do you quantify that? What does that mean? So hopefully they'll publish some case studies in the future. And I've talked to some people at the company where it sounds like they're going to, but yeah, it really is about that two-pronged value proposition of better consumer experience and total cost of ownership savings. But in terms of your other question about B2B and doing payroll, I was just saying that ultimately it eventually flows down to the consumer. So, but you're right. There definitely is a gigantic pure B2B market, and I have no idea what the actual number is in terms of TAM off the top of my head. But yeah.
Yeah, and I mean, look, just from what we've heard on the tidbits in terms of fireside chats, earnings previews, interviews, and the like, from B2B to C to small merchant businesses, SMBs, or B2B, like pure B2B players, like the market, the total addressable market is large enough where the only risk is really execution risk of, can they continue to get some big names moving onto their ecosystem? So it doesn't seem like the opportunity, like the runway, isn't long enough. It's just, can they, get going in the way that we expect them to? But that's more of a long-term opportunity. I mean, I don't think Galileo is going to start to pay real dividends until at least a couple of years from now.
I got another two-pronged question, if that's okay. Yeah. One, do you think that that Technisys was a good purchase? Did you like the way that we spent 10% of outstanding shares to? Well, actually, we didn't. It wasn't outstanding at the time. It's outstanding now. But to acquire Technisys, was it a worthwhile acquisition?
I think if it does what we've been told it's going to say it's going to do and teased over the last few quarters in terms of putting them in those conversations to land a top 10 bank as a customer, or land a massive fund or something along those lines, then yes, because that really does require them offering a lot more than just payment processing, because I mean, the theme of the last year and the last several years is just doing more with less and vendor consolidation. So whoever can do more of that and consolidate more functions and more utility onto one platform and one vendor. Again, lower total cost of ownership. Sorry to continue sounding redundant, but that's extremely important, and that's what Technisys really allowed Galileo to do by not being just this one-dimensional payment processor. And if they can sign a JP Morgan or something like that, and I probably shouldn't have said a banking name because people are going to say, well, are they going to sign JP Morgan? And to answer your question, I have no idea, and you know as well as I do if they're going to sign JP Morgan. But the idea is that Technisys put them in these conversations and put them in competition for these gigantic whales, which would solve this revenue growth acceleration very quickly, because the revenue ramp would just be crazy compared to what they normally get with these tiny wins that they're announcing. But yeah, it's sort of conditional upon if Galileo and Technisys together can land these gigantic customers that Noto and Lapointe are confident or seem to be confident that they can. And if that's true, and they've been reliable so far, and they haven't been used car salesmen so far, and they've fulfilled their promises made, promises kept. And so I kind of want to give them the benefit of the doubt there, but that is what I would like to see to kind of objectively answer, was that a good decision? Yeah.
And Brad, do you the reason I got into SoFi was of Galileo, that like that AWS of fintech thing was really attractive to me. But then these guys are like, but the consumer banking boring. I'm like, but banking's boring. But then, obviously the whole point of narrative of SoFi and Chamath's entire presentation was like, this is the future of banking. So that has also got me excited. If you had to pick between consumer banking versus Galileo, what is the thing that you like the most about the investment thesis?
Yeah, I like Galileo better, and I like owning the back end and the software better, just because we talked about this, all of us before. So sorry, you guys are going to have to hear me repeat myself, but it's just, I mean, fintech is a really explosive growth area, and there are so many of these brands, not so much anymore as these VC funded cash burners have kind of fallen by the wayside, but still there's so many brands competing for eyeballs and competing to draw people onto their platforms for what are, at the end of the day, pretty similar product offerings. I mean, high yield savings accounts and SoFi can kind of differentiate itself there. But for the most part, a checkings account and all these things, they're largely commodities with a few bells and whistles that you can kind of put on them to make them more appealing to consumers. So by SoFi having these technology clients like Robinhood and Chime, with Galileo as revenue generating partners for Galileo, that kind of allows them to participate in this fintech evolution or fintech revolution and all of this growth that's expected over the next decade, without solely relying on competing on brand power, which again is just really, I mean, special brands, they're very hard to call out and to see before it's extremely obvious in hindsight. I think at least it is for me. So relying on just a juggernaut consumer brand, and yeah, SoFi, they're getting your money right and their marketing machines, and it's all good. Like that doesn't make me nearly as excited or nearly as comfortable as Galileo and Technisys and SoFi all together participating on the back end and serving these gigantic fintech companies that are spending so much money to capture the market share of what will largely be not a very high margin opportunity and prize. So what is high margin is software and technology and differentiation there, especially now that they migrated it from on-premise to the cloud, which I think they said they wrapped up last quarter. But that really is what excites me more about the company, and that really is, I think, what insulates it from this commoditization that's inevitable for fintech, just like it was for legacy banking and legacy financial services. So,
I got two questions here. When we first got Galileo and Technisys, it was my understanding like the primary focus for the company would be kind of the next gen banking core, because not a lot of banks in America are on that, and that would be an awesome product to sell to banks. But do you think that Galileo and Technisys seem a little unfocused? I mean, when I bought into SoFi, I wasn't thinking that we're going to be doing a lot of whole B2B payment like deals or anything like that. And then also Galileo and Technisys aren't growing as fast. Like they're growing, but like it's not nosebleeding growth that we're all here for on
I think
SoFi.
it's a market shift completely.
I think
what
do you think? Because I feel like a year ago we had a different story about what Galileo and Technisys was trying to do and what they're doing now.
Ken, you want to go ahead, or you want me to?
No, I was just, like I've already said before. Like I think it's just the market right now. I think there's very little clients coming into the space, and we're hunting bigger fish now. I think we need to land a large financial institution. They've been talking about it. They've been talking about landing large retail consumer platforms. I think that's the key right there. And another thing, and this is something that I made in my last video, just talking about how there's kind of different waves to how Galileo and Technisys make money, right? It's bring on the actual clientele. All right. There's 11 new ads to Galileo side, 16 new ads to Technisys side in terms of clients. No one asked if those were cross-sold, which I wish they did, because I would love to know if they're actually bundling these clients. But anyway, all I'm saying is that once we add those clients, that's not immediate revenue, immediate account ads, right? That comes later. And this is something that Chris Lapointe spoke about, is that once that actually happens, then we add accounts and then we add revenue. Like those are forward indicators of future growth. So yeah, I just think we're shopping for bigger fish. But Brad, I'd love if you had a different opinion.
No, I think that makes a lot of sense. Also, I mean, $6 million in terms of churn, that's a big hit for them in terms of Galileo's growth rate and the incremental revenue they're putting on, and for the next few quarters, that's going to be in the year-over-year comp, or hitting them on year-over-year comps before it normalizes. So, I mean, I agree. I think they implied like 11 to 13% growth. That's what I can only infer from like them saying low double-digit growth. So definitely going to be looking for that ramping of growth there, because it is an important part of the investment. And I do think it's not only it's that churn, it's the fact that they've kind of pivoted their go-to-market, and it's also the fact that the companies kind of relying on new logos right now for growth are finding growth very difficult, just because approvals and the approval process is just being drawn out and lengthened so much. And I've heard from countless companies, the portfolio like CrowdStrike, saying there's just whole new layers of delegation happening, or there's whole new layers of decisioning happening, just because people are trying to delay spend while kind of the macro picture shapes up a little bit and hopefully becomes a little less daunting. So they are kind of reliant on landing these big fish right now for a reacceleration of growth, and it is sort of a tough sell to kind of rely on new logos to power that reacceleration, like we've seen for a lot of companies. I mean, when companies are relying on net revenue retention, like a JFrog, for example, and that's where they're getting the vast majority of their growth. I think they've got like 5% customer growth and 130% net revenue retention, and that's been an easier hill to climb over the past few quarters, just because you've gotten through the onboarding process, and you've written up standard operating procedures, and you've integrated them into your platform, and it's just an easier process to upsell than to sell new. So that was probably too long of an answer, so I apologize. But that's kind of how I see it.
Well, and then
you're too hard on yourself.
We can just to piggyback on that. Then, I mean, when you add the added benefit of Technisys onto Galileo and the cross selling that they get there, I mean, they were talking on the call about like Latin American expansion as like something that Technisys was helping them to achieve. It just seems like the value of the whole is more than the sum of the parts when it comes to those companies together, and I think that's just going to accelerate more. One question I did have though on the Galileo, like before we pivot over to like the buy now pay later or the stock-based compensation talk, I noticed in the technology segment that the margins had declined. Excluding Technisys, the contribution margin was lower in Q4, 24%, I think, this quarter versus 38% the year prior. And the actual expenses for that technology platform had increased. It seemed as though that was a trend that had started a couple of quarters, and it was just going lower and lower in terms of that actual margin. Of course, the growth is slowing because of the macro condition with regards to like the B2B space in general, lowering spend. But I'm curious, was there anything specifically for this quarter that contributed to the higher expenses and the lowering margins? And is that something that you think will continue in 2023 as the macro sort of the landscape is shaky, let's say?
Yeah, so great question. I think a few things that I kind of want to answer that. So first, the shift to the cloud has been very expensive for them. I mean, and it wrapped up last quarter, which is why I think leadership was able to confidently tell us that this is the bottom for contribution margin for the tech platform contribution. For the tech platform contribution margin, sorry, that was so redundant. But basically, now that upfront spend has been incurred on that migration, they can kind of focus on R&D and product development and kind of unifying or finishing the unification of Technisys and Galileo and finish integrating that with SoFi's own tech stack, so it can enjoy cost savings and vertical integration, so it can offer things like higher APY and better top of funnel and all those wonderful things. So that's another thing. Bottoming of the tech platform contribution margin, they said it's going to happen, and it needs to happen, because I mean they're telling us part of the investment case is them telling us that Galileo Technisys is going to operate at a 30+% contribution margin run rate, and they're now, I mean, well, ex Technisys 600 basis points away, and with it 1,000. So I mean, they've got a ways to go, and kind of like we've talked about before with the whole take their word for it, because they've delivered so far. That's kind of where I'm at right now, but they have to prove that trough is in, and then the tech platform contribution margin can expand. And really, what's going to help that expansion is a revenue growth acceleration, which a lot of that will flow down the bottom line and aid margins, and it's going to be related to them landing these whales and these big customers that they're relying on, that they're counting on to come over, which is why they spend so much on Technisys, which I think that's probably a good segue into stock comp. If you want to talk about that.
If I could just add really quickly on the contribution margin, Chris Lapointe, the CFO, for everyone listening, the CFO during his Credit Suisse chat right before Q4, I think that was anyway, I think it was in November or something. He actually said that the contribution margin was going to expand to 40% in coming years. So I'll send you that transcript after, Brad, but extremely exciting. And that's after we've had Technisys, which supposedly had brought the margin down into the low 20s. So I don't know. I like that's why I think there's a difference between how excited they are and then what they're delivering here in the short term.
Yeah, I mean the only downside, like they are the product roadmap right now, or what they're trying to ship and how many things they're trying to do at once right now. It's ambitious, it's bold, it's almost a little bit, are you biting off more than you can chew? But I mean that's the whole theme of the company. They try to do everything, and they try to bring that all into one platform so that they can cross sell and borrow benefits from one platform to sharpen underwriting in another, to create that slight difference in commoditized services and to win market share. So
right. Yeah.
So before we go on, sorry that I'm like periodically laughing. It's just the chat. It's just wild tonight.
Bro, our chat on SoFi Weekly is the best chat on YouTube, bro. Like, there's like so much shit going on there. That's how you know the audience is engaged. It's like some people are talking about SoFi, other people are talking about Tanner's glasses. Tanner, they said you have grandma glasses, by the way.
No, okay. So Brad, just to give you some update here, not everyone's saying I have grandma glasses. The only SoFi bear in the entire chat, Chris, all right, whatever, man.
He called you Tabby, bro. He called you Tabby. He said Tabby's grandma.
Whatever, man.
It sounds like a grandma name, bro. Tabby.
Anyway, let's go on. I don't care about the chat right now. Let's go on to stock-based compensation. Let me hear what you thought. $70 million, 16% of revenue. That was this quarter. It seems to be going down. What are your thoughts?
Yeah, I think the two themes are going down fast and needing to continue going down fast or quickly. Probably that's grammatically correct. But it was 16% of sales, still sort of egregious. But when you look at the year-over-year comp at 28% of sales, it becomes a little bit less ridiculous because they're moving in the right direction. And I know the Chris, and I don't want to butcher the pronunciation of his last name, did a great piece on Hager. Did a great piece on how there's restricted stock units tied into that are never going to vest, and that counts towards stock comp, and that's weighing on this metric. But that fall, paired with the fact that they told us or reiterated that it's going to get below 10% of revenue starting in 2024, paired with the fact that they're now telling us GAAP net income profitability is coming Q4 2022. That GAAP net income profitability relies on them kind of getting their shit together on stock comp. and them guiding to that in 12 months is them telling us that that's what they plan to do. So falling quickly, 16% of sales is still too high. But I mean, and I don't want to pick on any companies, and this is not a very high bar to clear, but I mean, there are companies like Unity that it's like 40% of sales, and they're growing at 20% year over year, and this company's compounding at 50%. 16% is really not that egregious for a company growing this quickly and trying to hire so aggressively and expand so aggressively and add so many products like Technisys and its tech platform all at the same time. But because it has a banking charter, and so because it's now sort of considered a bank with a lot of bells and whistles by people who maybe don't believe in the company very much. 16% of sales is rightfully a gripe that they have, and need it to fall below 10% of revenue in 2024 for them to meet that GAAP net income guide that they've offered. And again, they've given us no reason to think that they're full of it with anything. So until that happens, I'm going to kind of trust them to tell me what they're saying is true. Yeah.
And speaking of that, I'd also like to go into a little bit of the stock itself and the valuation. Do you think that, getting the bank charter was the right thing? Do you think it hurts valuations going forward? Do you think we get treated sort of like a bank stock rather than, a tech company? Do you think we should have, rented a charter instead? Like, what do you think, should have happened?
Yeah. So, Koifin's loading for me so I can pull up the forward multiples, but, in terms of valuation and do I think it should have gotten the banking charter? Yes, I definitely do. It not only makes them infinitely more profitable, or not infinitely, that's a bad word, I shouldn't use that, but significantly more profitable on their loan book, because they don't have to use these warehouse facilities, and they can fund it with deposits. And even when they're paying 3.75% APY, I think they said it was like 190 basis points cheaper with the charter still versus their warehouse facility. So there's still that much more room. Absolutely crazy. But not only that, and not only their loan operations becoming that much more profitable, but the fact that they can now again tie this sponsor bank service into all the APYs they're offering with Galileo and Technisys in this multi-core banking platform to kind of sweeten the deal a little bit for a Chime or for Robinhood or for somebody to go with SoFi instead of one of the other formidable competitors like a Stripe, which is where that churn hopefully, or not hopefully, but apparently went to. But yeah, it not only helps on the loan book and is the source of them being able to compete for customers with that APY on their savings account, but it makes them a more attractive client and more attractive partner for these technology platforms, going with Galileo and going with Technisys. So it helps them compete kind of in two places. But in terms of valuation, the EBITDA multi, Koifin's being so slow for me, so I'm going to have to do some math here super quickly. But where's the market cap at right now? Is it in the 5s or the 6s?
It's like,
yeah, it might be 5 billion now, I think.
5 billion.
Really?
So I mean 270 million in EBITDA, so it's trading at a teens EBITDA multiple. That's doubling year over year. So I mean, if they do become GAAP net income profitable, and if we get a lot of margin expansion on that line, the argument of this being expensive is going to go away really quickly, because that EBITDA, when you're looking at their GAAP net income incremental margin that they're putting out at 42%, that is going to flow pretty well down the bottom line. But apparently I'm missing something really funny, because
yeah, no, I'm not even looking.
Tevis is
I'm dying. I
no,
can't.
Bro, don't
I gotta not have it up.
You can't play poker, bro, because you can't.
I'm so bad at it. I'm so bad.
It's been cracking me up, and I didn't even look at the chat. Just laughing for me.
This right here, this one right here got us, and then this one right here.
It's like, it's when I read it on the screen, it's not even funny, but I know I'm not supposed to laugh, and that makes it even more funny. I can't do it, man. I should just not have the chat up.
I don't even have that. Like it doesn't make my eyes bigger. Like
it's a joke. It's just funny that they're roasting.
I know.
So Brad, just for context, in our whole chat, Chris is like the biggest SoFi bear. So the fact that he particularly is just throwing all the hate is just hilarious.
All right, but we don't have a lot of time with this guy. I got a lot of questions. All right. I'm going to need to have you on just for my own thing. Jeez, these guys are just distracting me. like just plain and simple, is I mean it's an easy question because you own shares, but is SoFi undervalued?
I mean, yeah, I would have a really hard time answering that objectively. So I mean, I own it. And,
for you.
yeah, I struggle to answer that because I own it and still own it and I'm not trimming. So I think that kind of answers the question. But I own shares, so I'm very biased and have a hard time being objective. But I mean, just pointing that combination of the teens EBITDA multiple, with which EBITDA is I mean, Charlie Munger calls it a fake profit metric, and rightfully so for a lot of companies, but paired with that gap net income guide to profitability being moved up by a few quarters, paired with that incremental color that they gave out about gap net income margin, it's going to do in EBIT. So getting rid of depreciation, it's going to be close to 300 million in run rate EBIT pretty soon, and that should be that should be sort of because they have a lot of net interest income. So that should be a pretty good indication of where net income is going to be in a few years, which doesn't, I mean, in terms of growth and a PEG ratio, that puts them very close to 1 very quickly. Sorry if I don't know, because I own shares, so it's like, of course I'm going to cheerlead, and I don't want to cheerlead, but do your own research and disagree with me and tell me I'm wrong, and that's completely okay. But when their EBIT is compounding at a near 100% clip over a multi-year period, and they're giving that extra color, it's expensive as a growth stock right now, but even as a growth stock compounding at 25 or 30% for the long term, it's going to be very affordable at this valuation very soon if they do what they say they're going to do.
Right. Correct me if I'm wrong, but back in like 2017 and 2016, before Noto, wasn't SoFi like valued in the billions, like $3 or $4 billion? I've read articles back in those days, and like there were some valuations thrown around in that level, and it's crazy to think that 5-6 years later we're hovering.
I think there was a buyout offer, if I remember correctly.
Yeah,
I'm sorry.
Like 7 or 8 billion or something like that.
Yeah, I think they received a buyout offer.
Yeah. And I mean, I'm sure you guys know about all that, the frat party culture stuff. And,
Oh yeah.
Yeah.
I read your Motley Fool article on it.
Yeah, and I mean, yeah, the frat party, and they were lighting money on fire, like they really were. And
he lied to investors too.
Yeah,
they were not getting their money right.
Okay, so Brad, hold on, Tannor. I can ask questions too. I think we're going to ask the same thing. So I think one of the things that's been, I promise I'm not going to, I turn off the chat. One of the things that's been polarizing on this pod, or a topic of debate, let's say, has been buy now, pay later. That's something that, okay, on the B2B side, I think mostly we're all in agreement that it's a good thing that they can just offer that to other businesses, but more on the B2C side, for not Galileo, but for SoFi offering buy now, pay later. What's your thoughts on those, and where do you think that can go? Like, do you think that that's a real sort of potential for the business, or do you think it's just something that, they're launching as a sort of feature that's a nice to have for users, but doesn't really contribute too much, or doesn't have the potential to do so in the future?
Yeah, I'm kind of biased, almost against the buy now, pay later as a full company. But as a tool in a toolkit, I think it kind of works. Just to combine it with checkout and all those things. But for SoFi specifically, and candidly, I have not tried to go through the process of buy now, pay later through SoFi. So if any of you guys have, please interrupt me. But it sounds like you go through MasterCard and kind of have to request this virtual branded card, and then you get acceptance, and then can use it for a transaction. And to me, just thinking it through, and I also own shares of PayPal, so I'm very biased positively towards that company as well. But when they have the buy now, pay later just as a button on checkout and click and done, that seems more seamless and less frictiony than kind of the form factor that they're describing here with the apply through MasterCard for a virtual card, and then use that to get approved for the loan. I don't know. It just
Let me give a little color to that, because all you got to do is go to the app. You pick how much money you want. So let's say $400. You type 400 in. You press a button, and then it says approved, and then it'll have another button say add it to your Apple Wallet. You click that, and then you tap one more time, and then it's in your Apple Wallet. So you can scan it in a physical location, or you can go to a website where it has Apple Pay checkout, and then you can click that and choose the SoFi Pay in 4 card.
But,
So
but I
you're
think the
right,
point,
but like PayPal has their own button, so it's like we're piggybacking off of Apple Pay.
yeah, I think the thing that Brad sort of said still stands, right? Is that like you still have to enter the amount that you want before the purchase and everything like this, versus just like, here's how much the item is, check out now. You know what I mean?
But it's all in one app. Because like I have Affirm, I use Affirm once every month or two just to use it, and I wouldn't use it if I was right into my SoFi app, and I feel like SoFi in the long term would have a better data set on its users than Affirm does, and they would be able to offer more you would be able to do bigger purchases with their SoFi Pay in 4 than you would be able to with an Affirm, because just of the data that SoFi has on you as a member.
So it's all in line. It's all like you go into like the buy now pay later app, and it in the checkout all happens there, or do they send you back to the merchant site? Or
no, it's just literally like a credit card. You just type how much you want, and it automatically funds you a credit card with like a virtual credit card that expires within a month. And as anywhere that MasterCard is accepted, you can buy anything. Of course, SoFi has in the short term like limitations. You can't use it to buy groceries and stuff because they're trying to test it all out. But it's a very simple, like easy process. I'm kind of the odd man out here on this podcast because I actually like the product and I think it's cool, and it's kind of like giving more value to SoFi's whole consumer proposition and making the app more sticky. Even though it might not make us like a bunch of money, I think it's something that.
Let's ask Brad that. So yeah, Brad, what is the financial incentive for SoFi to even offer buy now pay later, or are they just and I mean SoFi the app, right? Not Galileo and Technisys, because obviously I'm a big believer that that's going to be big as well. But in SoFi app, what is the financial incentive, or is it just to stay in the market?
Yeah, the incentive for SoFi is, well, all these other companies have this, so if we don't have that, then they have it and we don't, and there's this layer of flexibility in terms of payment schedule that they're offering that we're not, and it goes back to that theme of banking services being really similar, and needing to stand out any way you possibly can, and them seeing this as a void that they need to fill. But it's interesting because I mean, and just using PayPal as another example, the benefit that they get is really it's higher conversion rates and higher average order values, and that translates into more gross merchandise value or GMV for them, which means more revenue and more profit eventually, and that's really how they benefit. They don't even charge merchants for using this. They just let them enjoy this kind of, they call it a halo effect of more payment volume because you're offering that. So kind of thinking that through on the SoFi side, I mean, they would definitely benefit through more interchange fees, and their debit product is extremely high margin compared to pretty much everything else they have in financial services. So yeah, that would be just another, I guess, or a fewer, or how do I want to say that? But one less friction point, or one added layer of convenience, kind of incentivize these shoppers to spend more through the SoFi platform or through their SoFi cards, for them to collect this high margin revenue. So it's just them making the experience better. So indirectly, I think it could benefit results, but like in terms of the buy now pay later product on its own and just kind of in isolation, which is why I don't like these, or I never understood these standalone buy now pay later companies, because it has to be a tool. It has to be rounding out the toolkit, and it can't be the only thing in it. But that's kind of how I see it. Yeah, I'm glad.
And like you said on your PayPal deep dive that no one else aside from me has probably read the whole thing, at least in this chat. What I would say is that you also said that because they had so much information, like about transaction history on clients that before the buy now pay later product, that they actually have a way better way of actually pricing it, and in actually, lowering the risk per client versus in Affirm or an Afterpay.
Yeah, and I mean, they also do things like take balance sheet risk for merchants, which maybe if Galileo and Technisys kind of build out their client base, they can offer that as maybe an added perk. But yeah, I mean, I think you said it well. Was there a question baked in there that I missed?
No.
I don't know.
Okay.
I just want to
I mean,
make
you
sure
were quoting my deep dive, so of course you said it very elegantly and well, and it sounded insightful and groundbreaking.
I just want to make sure that you're good on time, by the way.
If you need to dip, Brad, that's totally fine. We kept you for an hour, so
I think we only have like 10 minutes left, anyways.
yeah. So if you need to dip,
I might have to take off, but this was really fun. And thank you very much for having me, and looking forward to holding Sofi shares, I guess, and hopefully I'm not wrong for doing so, which is always possible. So have a great night, guys. It was great to meet, I think, all of you face to face for the first time. So
Brad's Twitter is in the description, Substack in the description. Substack is pinned. Make sure you check it out. It's all free.
And how do people follow your trades? Don't you use, or how do people follow your portfolio?
It's kind of it's the URL is a little bit weird, so I'm not sure how to say it well, but it's savvytrader.com, and then it's like dash and my account and dash another thing, and then a third party cookie. So it's
is it linked to your Twitter somewhere?
It is not, but it's linked in every single newsletter. So
it's really cool because like every time you start buying, I get emails, and it's kind of cool. Like I could follow what you're doing.
It's a nifty platform. I think it's a good piece of software, and it makes it really easy for me to keep track of like allocations and things like that. So not to give them a free plug because I'm just kidding. I'm friends with the.
I know the owner of Savvy Trade. He's a good guy.
He's a great dude. Yeah, he's a really nice guy.
Yeah.
All right, guys. Well, have a great weekend. And talk soon.
Thanks, Brad. Appreciate it.
Thanks, Brad.
See you later. I was going to read a quote of Brad's here whenever we were talking about the leadership, and then Tevis thought that we were on the same page. We were not. During the leadership,
I wanted to be up there.
During the leadership conversation, he said, Noto has continuously set ambitious targets and subsequently delivered on them. His track record is pristine, and the early results he has delivered have been simply excellent. For a young company full of potential and risk, choosing strong leadership is among the hardest and most important decision ever to make. Sofi nailed this one. I thought that was such a great.
Brad?
What?
Who said that?
Brad.
Brad.
It's such a great way of sort of, seeing where the company was previously to where it is now. It's a completely different beast, and yeah. No, I'm really happy we had him on. That was a ton of fun.
He's really sharp. Like, man, he does like he's just reading and writing 24/7. Wow.
Yeah, 30-page deep dive is a lot, bro. That's
So if you guys want to get into maybe a little nifty couple conversations, I also had some smaller things that maybe you guys wanted to cover. Potentially stir up some drama. Maybe I'll turn the light red and I can go to Bear Tannor.
But before you do that, I'm all for it. But before you do that, I do want to say that something that I've been waiting for since August of 2021 is an investment platform user interface update. I think Amit can attest to this. It sucks. It's super bad. But it looks as though Sofi is actually focusing on revamping their user interface. And I know that doesn't sound like it will contribute to the stock price, or not stock price, but like just, I think that will put a lot of eyes on Sofi if it actually has an app that's like clean and user friendly. I think in the long term that can generate a lot of good member growth.
Did that update you posted, Riley? It's like real that like they rolled out.
It is real in that it is from Sofi directly. Sofi did create this, but it is sent privately to a few members through a survey. And what they're trying to do is they're trying to ask you to do something, and then they record your in-app behavior while on this website. because they want to see how easy or how well their product is. So it is something that they've actually created. There's no like update on if it's going to be coming or if that's like the final product or anything like that. But it is just cool. This is the first time we've had like huge UI news in over a year for sure. So.
Oh, also, I wanted to bring up something about this SoFi Weekly, just really quick. Last time I asked for SoFi insiders to message me. I got a message from a SoFi insider who
You're
I promised
kidding.
would remain anonymous because they
Wow.
are just telling me absolute undisclosed information. So,
shit.
Yo, what was that laugh? What was that squeal? Did you hear that?
Oh,
That was
dude.
pretty bad.
Anything you can share?
So yeah, so they they are not that high up. They do work in SoFi, the SoFi Invest platform, and from all the talks that they've been hearing, it looks like level 1 options are going to be coming out in Q3, not Q1. So
Oh wow, that hurts.
further back than what we thought. But yeah, still good to have, you know, some pretty good information come in if we hear anything, and I'll share what I can. I'm going to keep most of it to you know, just make sure that whatever he says doesn't get him in trouble and everything along these lines. But yeah, so that's also really
DM
exciting.
me.
What?
I'm talking to the person that you're in cahoots with.
Eric, give me 1 second, all right?
Okay.
What just happened?
So, Tannor
I don't
just-
think he's ever turned his camera off.
Yeah. What's he? Is he going to
What?
get us a gift or something?
He turned it red.
Oh, he turned it red. Okay.
Boom. All right.
Wait. So how much money are you guys up this week?
62% up.
Riley tweeted that he is the best month in.
I didn't say the best. I said who can beat it, and there was a lot of people.
You're
that
up
could beat it.
62% in the month, correct?
It is like 65 now, but yeah. Or
This
it's
was
probably
actually
changed since
my
then.
this was actually my best month on not a percentage basis, but a dollar basis.
Yeah, because you've been adding probably while it's down.
Yeah.
Yeah.
I feel
No.
so
So
sad. I'm not going to be able to buy SoFi at 4 though. It's just like. what
Well,
an
I don't know. Okay,
opportunity.
so can we ask this question? I don't think this run up was necessarily healthy. I think it was very euphoric for all the wrong reasons. Obviously, SoFi deserves to be there. All of us think, but I think we're gonna get a pullback, like relatively to 6 or 5.
Dude, the pullback or the continued run is not dependent on SoFi. Like, I just want
Agreed.
you guys to understand that
100%,
it's all
100%.
macro. The Fed can come and just kneecap this entire market with one statement. But the entire run up, and it was interesting when, you know, Brad was saying like this was one of our weaker reports, and the market, you know, it ran and it actually held that run after this report because of, in my opinion, I'd love to hear your thoughts. This was a report when Anthony Noto literally went on Fox, he went on CNBC, on Bloomberg, and I think a couple others, because I was clipping them together today. Every single one of those interviews, including the earnings call, they were hammering home one point, and that was profitability in 2023. And I think that's what the market is looking for in this day and age when everything is rough. They're looking for profitability. And, you know, 2021 was pure growth at all costs. 2023 seems to be just pure sustainability at all costs. And them just hammering home that point is almost like clickbait, you know, for a lot of people to jump in, because if SoFi says Q4 profitability, they probably are internally targeting Q3 profitability, something like that, because I think the company now has double beat on, like, for the last 2 years, ever since becoming a public company. And so it's sort of become a trend where they under promise, over deliver. So that's, I mean, for me, I'm looking at like Q3 profitability, even though Noto is saying Q4. So I think that's the mantra that the market sort of banded behind to cause that rally.
Someone said in the chat, insiders can message me on Twitter, but yeah. I just think it's because the DPEG. I think the DPEG from other lenders means that SoFi is the last lender standing. you know what, we even lowered the amount of provisions for loan losses, opposite of what some bears were assuming that was going to happen. And you know, these are all great signs. Do we have any time, or are you going into the Palantir Weekly right now?
No, we got 5 minutes.
Okay. I'm going to quickly just leave, or maybe I shouldn't leave everyone on a bad note. What do you guys think?
Yeah, leave us on a bad note.
Okay, let's go into it, and then we can dive deeper after everyone's made a video on it.
Okay.
All right, here we go. So what I'm looking at here, everyone's seen before, or at least I hope. This is the product breakdowns for SoFi, okay? Now, unlike what everyone thought was going to happen was, you know, SoFi Money was going to bring on a ton of new customers because of the 3.75%. And they did. They brought on a good amount of customers. You know, definitely not held up by SoFi Invest. But what really no one is pointing a finger at, no one's wagging the big finger at Relay, adding 321,000 new accounts, and the growth is growing quarter over quarter. What
does that mean, though?
I'll tell
Because
you.
they don't make money off of Relay.
I know, and so this is why my lights are red. Okay, so we added 321,000. That is the big bulk of why we even got, you know, the amount of new members that we did. All right, or sorry, new products. I can't say members, but out of the 700,000 new products, 322,000 was Relay, a good product for us, but not nearly a market leader. Let me switch on over to, let me switch on over to here, where the cost of acquisition was $344 per person. Okay, which is lower than last quarter, but it damn well should be, considering that a large portion of the clients that came on to use a budgeting app. Okay, came on to test, you know, to see their credit score, to see these sorts of things, and we're paying $344 on average per client that wants to use our budgeting app. Now, hold on, okay? Because it's not that bad, all right? We are still cash burn, or we're not cash burning. We are positive. We are making real profitability this quarter. So don't look at the PE ratio. Chris Hager, go read his article. But like, a lot of our actual expenses are actually non-cash charges that don't affect the business, okay? But it is still important to understand that our cost of acquisitions on our loan side must be in the thousands. I mean, truly thousands and thousands of dollars for these clients if our Relay is still averaging $344 customer acquisition costs. If anyone in the chat wants to argue with my numbers, let's go head to head. But aside from that, you know,
that's a good point. I mean, we didn't think about that all week. That's a deep piece of DD that you picked up.
Yeah, that's why people need to go to my channel. You get all that.
Can you all subscribe to Tannor so that every time he says to subscribe, you can be like, Tannor?
They already are. They already are. Go watch the last video.
Yeah, I mean, look, I kind of want to ask you this though, but okay.
We got to end in 2 minutes, guys. We got to be out.
Just taking the other side of the argument, from a user, like purely from a user experience perspective, not thinking about the money at all, what is that introductory product that you would have rather have? Like, what product do we have the best user experience in? Riley's like cleaning his room.
I know,
now,
like
not
mute if you're gonna turn it like.
Oh shit!
The camera falls over.
Because like just to finish the point, like I would argue that even for that flywheel later on down the line, if Relay is where they come in, like that's a good user experience product that we can then, number one, get information. Number two, like get information around the user, and then number two, cross-sell them to more things that's relevant to them. So, you know, sure, it's not optimized in the short term, but in the long term, I think if you buy into the flywheel bull case, then you're good.
I don't get it. It doesn't make any sense to me whatsoever. Why would anybody ever download SoFi for Relay when there's so many other better options for budgeting software? I don't see any advertisements for Relay in America. Anytime there's SoFi ads.
But that doesn't matter. There's 322,000 new ads just this quarter. So if you can't see
how
it,
do they measure that? Is that a link people click on, or
What do you mean? How do I measure? It's just the new product ads. That's going from quarter over quarter. How many, like they show you how many people have Relay, right? So there's 322,000 new ads this quarter.
Not
All
sure
right,
if
we
it's
gotta end
even
it there.
possible to get
I gotta
Relay
go.
without getting all the other products on the app. Anyway, that's my take.
I love the sword, Riley.
Now we're
All right, guys.
demonetized.
This was a good week. This was a great guest, great pod. This was great for SoFi. I think there's a pullback coming. I do not think this is sustainable at all. I don't think the Fed likes this, especially with the jobs report we got today. But if that's the case, then we'll be able to load up a little bit more cheaper and keep going from there.
Thanks, guys.
Cool.
Subscribe
Thanks,
to Tannor.
everybody. Yeah.
Don't subscribe to
All right.
anyone other than Tannor. We need
Just so you can
Tannor's-
shut up if nothing else.
Yeah.
Just subscribe to Tannor.
It'll never slow down. I'm gonna self promote till the day I die. Love you guys.
Bye, everybody.
See you, everybody.
Good night.
Bye.